I'm sitting here today with David Nathanson of Bellwood Capital. Bellwood Capital is a small boutique manager based in Newlands in Cape Town, focusing on offshore investing. David, thanks so much for joining us today.
Thank you.
All right, tell us a little bit about Bellwood Capital.
So Bellwood Capital is a specialist global equity manager. We manage global stock portfolios, separate accounts for private investors, typically housed with Interactive Brokers in the United States. Bellwood was started in 2012 by Peter Ebel, who was a director and shareholder of Coronation Capital previously. In 2012, when we started the business, we started managing only proprietary funds, and probably for the first 3 years, we didn't attempt to run it as a business, marketing to third parties. So what that does, it gives us a very unique investor perspective. We've managed it as an investor for ourselves first and foremost, and then at a later stage decided to branch out to third parties. So what this means, we're not a sales business focused company, and that gives us a unique edge. We're investors first and foremost, like our clients.
Okay, so who would your typical investor be?
So our typical client would be private investors in one of two situations. The first is either South Africans who are overexposed to South Africa, have the vast majority of their wealth in South Africa and are looking to diversify globally. So they understand that South Africa represents less than 1% of the world, and that applying old models of a sort of a 30-70 or 50-50 split between local and offshore doesn't make sense when you live in a small emerging market country. The other type of investor would be those who have already taken funds offshore but have invested it poorly or haven't given much thought to how they've invested it. So they're sitting in a lot of cash, or they're holding expensive funds with complicated structures, and they're looking to simplify that.
All right, you're a small team. Why would an investor choose to invest with Bellwood Capital rather than going to one of the large financial services companies that offer offshore portfolios?
So I think the main reason is that our clients buy into our investment philosophy and our process. So we are, true active asset managers. We don't aim to mimic the market or to limit ourselves to familiar household names. We apply a very considered process to a wide universe of stocks, and we pick our best ideas. So that's the first reason. The second is they're looking for a simple, cost-effective solution that is transparent, where they can understand what is happening with their investments, and that's what we offer. And then the third, they're looking for personal service. So they want to speak to the person who makes decisions on their account and understand what is happening, and that's what we're all about.
Okay, let's dive a little bit more into your process. What makes it so unique?
So most investors, and this includes professionals, probably invest on the basis of stories and predictions of the future. And the problem with this approach is that, firstly, the future is unpredictable. It's very difficult to know what the future holds. And even if you're right about what the future holds, that might not actually translate into investment returns. So what we do that is different, we focus on the underlying causality. What is the fundamental causality of what we're trying to achieve, which is return on investment? And when you focus on that, and if you can get those things right, you're far more likely to achieve your goals. So, what that is, if you're looking at a business really, or a share, there are two elements to that. The first is, how is the underlying business performing? And then how is it valued? What are you paying for that business? And really, you need to look for high quality, profitable businesses with strong balance sheets and good financials, and acquire them at an attractive price. When you follow our kind of approach, we aren't really targeting geographies. We aren't targeting macroeconomic environments. We're looking for specific businesses that have got the right preconditions, that have got low valuations, that have got strong balance sheets and so on. And that you can find anywhere. You'll actually still find most of those in the US, because most companies are listed in the US. We also find some in Sweden. We find in Hong Kong, in Australia. Wherever you look, there are opportunities to be found. So, that's also another reason why we favor, I suppose, our approach of looking for best ideas, is that if you look at the overall market, or the popular, the S&P 500, things like that, they're expensive, and we don't think returns from them will be that great over the long term. But you can still find, rather than having an in-out approach to the market and possibly getting it wrong, you can still find very good businesses that are very cheap, and we think that over 5 to 10 years they will do well for investors.
Yeah, so the best way maybe to demonstrate your philosophy is through some of your holdings. So take us through one of your key holdings and why you've chosen to invest in that particular stock.
Yes. So I'll go for something that isn't necessarily a household name, something that most people wouldn't have heard of. There's a Swedish software developer for the online gambling industry called NetEnt, and if we look at it through the lens of causality, first and foremost, this is a business that has been consistently profitable since they listed in late 2007, early 2008. Through the financial crisis, they've grown their business in terms of revenues, in terms of earnings, and in terms of the yields they pay to investors at 27% a year in real terms, which is phenomenal. And their share price has then tracked that over time. Right now, the company is trading on a 12 PE versus its historic average of about 27 versus 20 for the industry as a whole. So it is extremely cheap compared to its history. It's extremely cheap on an absolute basis. If we look at this company, it has got no debt. It has got cash flow that matches its profits. So those are the sorts of things we look for. It's a high quality business. It is expected to be profitable going forward. It is expected to keep growing in a growth industry going forwards. I think the important thing though is to look at it and say, rather than investing and looking at what can go right, we look at it and say, what can go wrong? And really, for a business with no debt, with all of these preconditions to do badly, it would require that the business just deteriorates out of nowhere, which is unexpected. And if we look at 50 companies with these sorts of preconditions, there will be one or two failures, but there will be a lot of successes as well, and our base rate will be very good, and that's really what we're aiming for here.
All right, on the flip side now, tell me about a company out there that most investors would know that you wouldn't invest in right now based on your philosophy.
Okay, so I think quite a popular, well-known household name that a lot of people would invest in that we just wouldn't would be Tesla. It's kind of the polar opposite of a company like NetEnt. You've got a business that is all about the story. It's all about the electric car revolution. It's all about almost a cult of leadership. Elon Musk is a fantastic engineer and has achieved a lot. And so because of that, people are willing to overlook a lot of other problems, very fundamental problems of the business. And if you look at it, chief amongst those problems is this is an auto company operating in one of the most competitive industries in the world. It is consistently loss-making. They raise capital, a large amount of capital every year. So the actual underlying business returns have been negative and aren't expected to be positive anytime soon. There are, however, lots of growth companies and opportunities like NetEnt, for example, where you have similar growth prospects that just aren't household names and they are cheap. So it's not a case of excluding every high-flying tech stock. It's a case of finding the ones where the fundamentals are strong and the valuations are attractive.
Okay, so how has your philosophy translated into performance?
Yes, I think firstly, we're looking at a very short term horizon, so we wouldn't necessarily be reading too much into that at the moment. But we've, in dollar terms, since Feb 15 to April 19, we've returned 19.6% or 19.3% net of fees, including all the cash. In rands, that would translate to about 46.6% over the period.
There has been a growing movement by a lot of investors towards a passive approach to investing. Why do you think your active approach, based on your philosophy, is a better option for investors?
As long as passive has a large cost advantage, then that makes sense for investors to be looking in that direction. But what it has done, what the passive has done to the market, the active market, is two things. Firstly, it's brought the cost down. So the cost advantage that passive has over active, particularly if you look at a low cost option, is quite narrow. And then secondly, it has forced closet indexes, those who track the index at a high fee, it has forced them out of the market. And rather, it favors now active managers who are actually doing something different, who are actually looking for their best ideas, who are looking across the whole globe and looking for their 50 or so stocks like
Bellwood.
So yeah, that's why we are the way we are. We don't want to be closet indexes. We want to be true active managers.
All right, tell me about your fees.
Our fees are between 0.45 and 1% per annum, depending on the size of the portfolio. And the only other costs involved would be brokerage into active brokers, which, to be honest, it's negligible.
David, thanks so much for taking the time to sit with me today. Looking forward to hearing more great things from you guys.
Thank you.